Got emergency broadcast with Kevin Green this morning. So I'm excited to have Kevin on. It's been a little bit, Kevin's been doing his thing. We've been doing a lot of shows lately on my end, so it's been good stuff. But I'm always excited to chat with Kevin about markets. I always learn so much. You guys always learn so much. So we're excited to have Kevin back. And really, the last couple weeks, there's been so much going on. The market's been moving in every which direction. Everybody's like, it's the end of the bull market. It's the beginning of this bull market. It's the end of that bull market. And once again, we're trying to always find the truth here because, as traders, it's not a game of, hey, I know this is going to happen for sure. I know gold is going to go up forever. I know this stock is going to go up forever. It's more of a, hey, let's take the highly probable bet, and we'll go from there. And to talk more through that, we'll bring on Kevin, and we brought some slides for you guys today. But first off, Kevin, how are you doing? We're glad to have you back. What have you been up to? What have you been seeing in the market?
Yeah, it has been pretty busy, so I appreciate it. Yeah, I don't want people thinking like, oh man, we fell off or anything like that. We just have to kind of readjust schedules. So always going to be able to try to find some time to do this report or anything else as much as possible. But we might need to, start finessing this over the weekend. Maybe do this monthly, and then every week, maybe we do something during the week after market close. Just because everything has been busy. But for me, man, everything, what I've been I've been harping this for a very long time, right? But it's really important now is you got to be tactical in your positioning. And what do I mean by that, right? Because it's easy to kind of just say that. You got to find the intraday or the 1 day or 2 day swing trades, capitalize, and then move on, right? This doesn't seem like a market where it's like a set it and forget it. Right now, maybe some pockets of the market that are not as sexy for like the intraday traders or the futures traders that are out there. But I feel like you got to continue to look at the technicals, be very tactical, because one day we could have, low beta actually outperforming. Another day it's risk on, and another day it's back to being low beta, and then another, all of this stuff. So I think you have to be, kind of cognitive of that, and just kind of that wait and hold approach. If you are somebody that really does follow the markets fairly quickly and likes to, do these 2 day or 3 day pops and swings and things of that nature, which is kind of what I focus on. The 2 week, 3 week thing, it just seems like it's not really like holding up outside of certain areas. And we'll kind of talk about that. But overall, man, there's a lot that's kind of going on in the market, and looking forward to kind of talking about them. So I'll have you kick it off. I would also suggest, though, people check this out, YouTube, subscribe, share it. If you have questions, put them in the comments in YouTube, easier for us to see. You want to tag me on a post in X if you have a comment or a question, by all means do that as well, and we'll kind of get after it and try to dissect these markets a little bit, man.
Yeah, no, I love that because we love to get questions from you guys. So feel free to write in at any point, questions you have, criticisms, whatever it is. We don't care. We're happy to be here and happy to chat with you guys about it. So we brought some slides today, and I wanted to bring this one up first because there's so many people. This got around quite a bit, and a bunch of people had a bunch of questions about it. And I want to explain a couple things about this. One is, when this part of the cycle happens, when we're looking at gold's outperformance, it's not just a thing of, hey, gold's just going to go up and everything's great and it's going to be this smooth ride. One, this is a monthly chart. If you're trading off of a 25-year monthly chart, you probably are trading wrong. There's no way to trade on a short term, even a 1 year time frame off of a monthly chart. But it's something we can look at for data. And for me, I'm looking at this and going, okay, one, if we are in a cycle similar to the 2000s, we'll probably see some of this rotation continue to happen. But also, I think too many people are getting a little bit too bearish on the United States. I don't think it's a thing of going like, hey, technology's dead, all these things are dead. I think it's just more of a rebalancing inside of our very tech-heavy S&P 500. And I think that would make some sense. And also, looking at the cycle, because let's say we are heading into a weaker dollar cycle, it would make sense for a lot of reasons. So if we are heading into a weaker dollar cycle, you will see this outperformance in these other areas. During the 2000s, we saw Latin America go up 600%. Some of the commodities were raging and so on. So it might be more of a commodity-driven bull market. But once again, there's a couple things to think about here. And during corrections in the S&P 500, what actually goes up or holds its value better than most things in the market? And that's gold. Gold could just be sitting here moving higher slowly, and it could just continue to move higher, or just be flat or slightly down when the S&P 500 is down quite a bit. So there's a bunch of ways to look at this chart. It's not just to say, hey, you need to buy gold, you're an idiot. It's to say, hey, gold is starting to outperform. Usually in that part of the cycle, we either see one of two things. One is the stock market heads down, or the other part of it is we see the S&P 500 kind of be flat, but some of those sectors like energy, financials, some of those reflationary style sectors move higher. So there's a couple different ways to look at this one. And the band squeeze is kind of just showing that, hey, this is a band squeeze breakout, which is mainly just showing you that there's change under the surface. So Kevin, I think you brought a chart on gold or the S&P?
Yeah, what I would say, when it comes to this chart, and I think people have to kind of understand this, when you're doing ratio charts, it doesn't mean one has to go up compared to the other, right? You're looking at relative performance for one over the other, right? So gold could go down, but it could go down less than the S&P 500, and then this chart here is still ring true as far as potential upside potential, right? Because it's on a relative basis, you're kind of looking at performance. So I think ratio charts are really good to be able to see, who's performing, who's outperforming, especially when you're in trend markets. But once again, it kind of says like, it doesn't automatically mean like buy gold, sell S&P, right?
Yeah.
And I think that sometimes that's probably why people get a little bit frustrated with those, because they kind of think, oh, you're implying that gold's just going to be the ultimate buy. And I don't think that's the case. I think you're just kind of saying what actually outperforms, which is what a relative chart does. Right.
Yeah, and look at something, something as simple as looking at 2020, for example. 2020 gold was a massive outperformer when the whole stock market was crashing. And then it continued to move higher a little bit later. So sometimes when you see the thing that you see the most in corrections, and this is kind of a very good thing to think about as a trader, if the market is correcting and you're seeing areas that are showing outperformance, and this is, you could look at COVID, technology went down the least out of all the sectors, semiconductors even less than that. Semiconductors compared to S&P 500 barely went down at all during the COVID crash. And then semiconductors, technology, they kind of led the way till right now, really. Like they continued to kind of lead the way. Gold had a really nice rally at that time. You see that peak right in 2020, even on this chart. So once again, it's not saying one has to win, but when you see this type of correction and you see that gold is breaking out a little bit, that might be telling you something. But this is a very long-term chart. In the short term, yes, gold is high. Gold is crowded on the long side. It could go down a little bit. And maybe some of these other metals and other sectors could start to catch up a little bit. And I think that's something that we're going to see. But I'm talking commodities here. I'm not even talking stocks. So Go ahead, Kevin.
No, I agree with you. Look, all right. So when you kind of look at the whole gold scenario here, we talked about this a couple of weeks ago. Obviously, I haven't been on in a fairly long time here, but like a couple of weeks ago, and I wrote about this on February 19th. So you guys can check out the Twitter, shameless plug. Check out my Twitter, KG Bull and Bear. You can see I write articles usually at least once a week, maybe throw an extra one out there. So the thing about the gold chart for me right now is I do believe that we still have a little bit more of a pullback to go. And actually, since I wrote the report, gold's been down about like 6.7%. So the gold move that we've seen pretty much for all of this year to start off was it was actually a physical short squeeze that was taking place, right? We actually had this massive movement from LME to the United States, a repatriation, if you will. And we're pretty much at COVID-19 highs when you're looking at COMEX inventory levels to the upside. And the deliveries that were actually taking place, these intent to deliver, and delivery intent, whatever you want to call them, right? Those are actually from the short side. So if you're short futures contracts, you actually have the right to exercise, if you will, compared to equities, anything that is buy side, you have the right to take action. So what we actually saw is these, these large institutions, the JP Morgans of the world, Deutsche Banks, what have you, every single one of them, every major player that's within the gold space were short these contracts because they were long the physicals overseas, right? And so they said, hey, we're getting this in the United States. Our intent to deliver, our intent to deliver is initiated, and basically they're delivering to their customers. Now, there's still a short position that's going to take place, and that probably will always take place. But the question is going to be, do you see actually those institutions, those large institutions actually getting back in and putting on new hedges when they don't really need to? And I think that's kind of where we're at right now. Managed money has really been kind of commanding the price action over the last couple of weeks. And managed money is just not a very sticky flow base. In fact, we actually saw longs for managed money last week actually come off. So if you're looking at the commitment of traders report. So I feel like there is still an institutional short. When I say short, there's a shortage of institutional interest that is taking place, and you can see this in the delivery notices that are now being initiated. 2 weeks ago we were looking at 2,500 to even up to 4,000 contracts on a daily basis that were being put up for delivery. Last week, Thursday, we saw 435 contracts. Now, granted, the contracts that are now being kind of traded on are the March contracts. There's only around 10,000 in open interest. And in first notice day, when it comes to the April contract, which is the active contract that has open interest there, it's still a couple of weeks off, right? Almost 3 weeks off. So should we still see a ramp up in deliveries? Probably not, because the open interest cannot support that. Right now, unless you see a massive ramp up and people trading the market, and no one's going to really do that on the retail front. So you're going to see a lull in these deliveries. You're going to see a lull in this physical short squeeze that has taken place. And that has also then coincided with gold coming down. And so I think that I think the trade's a little bit overdone. I think there's some technical pullback levels that we really do need to kind of focus on here when it comes to gold. And that doesn't mean like, oh man, like gold's going to 1,000. Right, it's still in its bullish phase or bullish uptrend, but I would say over the short term, next couple of weeks, I would not be surprised if you can continue to see gold kind of move back. And what I'm actually looking at for gold is a pull back to the 100, or I'm sorry, to the 20-week moving average, which is going to be 2740. And actually, if we can pull up my gold chart, I think I provided this to you.
Which number?
We're formal now, guys. I've got to get used to this formalness. Slide 13.
13. Okay, we're almost there.
So we're getting real fancy with it. Sam has definitely upped the bar for us, and I
gotta use slide charts, man.
I love it, man. I love it. It actually makes it a lot cleaner. So cool with that. So if you kind of look at this, so for people that don't understand, follow me that much, I'm a weekly chart guy, right? When it comes to pretty much every market, and then I drill down to the daily. And if you kind of look at this weekly chart and how it's actually set up here, that 20 period moving average, 2740 here, that moving average has been a very key area of support over the last 3 years, right? And we can kind of see that type of price action kind of taking place, or let's say since November of 2023. Once again, maybe a little bit of a pullback, another $120 to the downside there. That would actually have a technical correction there from the highs. And we also have this channel that has been intact, and we actually closed below it. Now it's a slight close below it, but once again, it's still a technical break of the chart. You have stochastics. Oh, I'm sorry, I don't have my stochastics on there. Stochastics is about to cross in bearish formation. You have MACD that's still in a bullish formation, but you also have RSI pulling back here and actually crossing that overbought level at 70. So once again, I think there still is a pullback to go in gold. Doesn't mean that it has to be a complete breakdown in gold, but I still think that this might have been, I think we're to the tail end of this. And until we get to that next contract, which is going to be the April contract, once we start seeing that and it opens up the first notice day, meaning that those shorts can start putting those delivery intent notices out there. we don't see the same type of flows of 2,500 contracts or 3,600 contracts or even 4,000 contracts coming through, I think that also kind of signifies the fact that maybe this euphoria may be over. So that's kind of where I'm at when it comes to gold over the next couple of weeks. Once again, not negative against it, but I just feel like the fundamental structure, the mechanical structure of the contract itself is starting to break down. And then technically the chart is technically starting to break down. There's also a bearish divergence on that RSI as well. If you kind of look at it, that's been kind of intact here for a fairly long time. So, but we'll, tying it back to that relative strength chart. Let's say gold does pulls back another $120. But what happens if the S&P continues to pull back a little bit more aggressively? Technically, the relative outperformance is still going to be on the gold side.
Yeah, that's kind of where I'm at on it, and I also agree with you. People are always like, "Man, you're so bullish on gold all the time." It's like, for me, if it's in an uptrend and on my time frame, it makes sense. But tactically, this is a spot where it's, hey, we're probably going to pull back here, and it makes a lot of sense to see that pullback.
Mhm.
I think too many people are getting too excited that things go up and they have to go up forever. If something's going down, it has to go down forever. It's just like you said, like, look at it tactically. Tactically, 2740 is a great level. Just around those levels in general, basically 2600 all the way to 2740. We're looking at a lot of support there. So looking at that support zone, thinking that we could pull back. But then I want to kind of go back with you a little bit, which is, let's go back to this ratio. So, we've talked about silver a bunch, and you and I kind of had the same idea, which Sam's big thing for this year was copper. You and I were kind of on the silver side. And kind of, to me, what I'm looking at with gold is, I don't think gold should continue its crazy outperformance if we're really in a precious metals bull cycle. We should start to see the moves into these other metals. And yes, I hear all the time things have changed. Silver's different now. China isn't buying any silver. Central banks aren't buying silver. But I also know the way commodities work cyclically. And I know that if gold is moving up, most of the time you see a rotation into these risk on metals, which are silver, possibly platinum and palladium. And once we see that move into those risk on metals, we usually see massive outperformance in something like silver. So looking at silver, it's kind of right at that level of polarity once again, where we could see that bounce. And if that bounce happens, it's usually a really good time for outperformance in silver. I mean, if you go back all the way on the chart, every time you see those type of bounces, you see really nice movements out of silver. And silver, when it moves, it makes these big moves. So, I'm wondering once again, are you thinking, for me, I'm kind of thinking, hey, everything's kind of lopsided on gold, but silver looks like it has some more upside to go. I would think the silver outperformance would have to start soon. But what are you thinking about silver? And I'm not talking about, the gold going down. I assume silver will not be, will probably be flat to down at the same time. But do you think the silver outperformance will start to happen sometime soon? This is a question that comes up all the time on here.
Yeah. I'm going to add another chart to this deck real quick, and then I'll answer that. So with silver, the thing about silver is that it just has not been able to break above and sustain that 32 level, right? And so I think, if we have this kind of pricing in of maybe slower global growth, silver's going to see some headwinds. And we've been waiting for that China trade, and it just hasn't really materialized yet as far as the actual economic data. And so I would say continue to trade the technicals with silver. That's what silver is actually really known for. And rather than trying to, see if there's going to be a long push there. Could it actually happen? I mean, it could, but once again, I think you're going to need to have the fundamental factors in order to really get this thing to move. And from a technical standpoint, there has been a little bit of a breakdown. Now we're testing the 20-week moving average. We'll see if that's going to be able to hold up for next week and get some buyers to step in. What I want to clarify, though, is there has been institutional buying across the curve when it comes to all of these metals, copper, silver, and gold. And so if we kind of go to slide 18, I can actually kind of show you. So the situation that I kind of talked about when it came to gold, the same thing actually has actually happened with silver. And in fact, silver has now actually hit new all-time highs when it comes to COMEX.
Which one's silver?
It should be the last one. I just put it in there, so I'm not sure. The very last one, slide 18.
Maybe it didn't update yet. One sec. I'll get it up.
So, Sam, that same type of structural situation that we saw with gold is the same things actually happened with silver. Massive repatriation of the contract here. So you get a little bit of concern once again. Do we have the institutional flows in order to really kind of support? And we don't have the answer for that yet. If you kind of look at it and say, all right, we're in kind of a little bit of a reflationary stage right now, no one really knows, is that reflationary stage really because of consumption trends? Because you can make the case consumers are kind of falling off a little bit, or is this because of a pull forward in tariff policy? I don't know. But what it does kind of look like here, and so this is from Macro Micro, so I want to definitely give them a shout out for this. You guys can check this out as well. But you can see that massive rise when it comes to inventory levels for silver. The same thing kind of looks like that for gold. So there's definitely some activity that has been taking place there. But the question that I have is, do institutionals step back in and reposition again? Which do they reposition and provide price stability and push prices higher? Or do they not have a need to do so? And I'm of the mind that, kind of looking at these cycles before, they may not have a need to do so right now. But the China story can actually change that. So what I'm looking at for silver right now is a support sitting at around $30.20. And then upper resistance, once again, sitting at around that $34. And until we actually get a meaningful break in one way or another, I think this kind of trades in its range and you just kind of, play it out. But I don't see anything that says, man, like silver should rip. And I know that there's this thought about, this catch-up trade. And the catch-up trade can be there, right? And I think that gives you the credence of, all right, are we actually in a super cycle type of behavior? But I'm always of the mind, like, I got to see it in the price action to really believe it. And right now, if you kind of look at silver,
we're not seeing it yet. Yeah,
the silver trade has actually been in a defined range since May of last year. We are making higher lows on a relative basis, making higher highs, but we continue to have these failures. So are we seeing a compression and buyers kind of stepping in? I think those buyers stepping in has to once again be complemented by the institutional flows here. But I do actually like, if you said, hey, gold or silver, I think silver provides a lot better trading opportunities because of the technical nature of how it trades, which I think is actually more important than gold right now. If you go on a daily chart, silver is fading, right? And so MACD cross, stochastics already cross failed, CCI down. So I think we kind of are in a little bit of a holding pattern. And if you kind of go back, and this is what makes it a little bit odd, these massive rises in inventory levels at COMEX is really not normal, right?
No.
And so you kind of also have to go back and say, why are people doing this? Is it because of tariff policy? You could make that case. I think you could actually make that case, a better case for that in copper because of the industrial use. But why is this actually happening? Is there something that's actually on the horizon? Because these rapid spikes when it comes to silver or even gold, when it comes to inventory levels or these repatriations between Europe and the United States, usually also coincide with something bigger that happens in the market on this flight to safety type of event on the physical side. So that's why I don't really have, until we break up or break out, I feel like we're still kind of in a holding pattern. And I personally like that trading environment for silver because it's a lot higher. It's a bigger beta play than gold. Even gold has had a really decent run. And silver made, in history, silver has been able to catch up. What's the reason for that? And what's the institutional flows to be able to support that? And those are the two question marks that I just don't have yet. And then when we start to actually see that, we start seeing producers starting to layer on a little bit more, the tone will definitely change. But for now, I think you swing trade, you swing trade or you technical trade this right now until you get that firm breakout.
Yeah, I think it's
and the China story can do that. China can completely change the whole game, right?
I think that's something that we're going like it's kind of the thing, and you and I both put a lot of weight on the price action, which is seeing the price action in China and seeing like think about 2008 for example. 2008 happens, March 2009, the market bottoms. We weren't in a position to say, okay, after this market bottom, obviously we're immediately out of recession, everything's great in March 2009. That wasn't the case, but the market started to bottom and started to move up. Very similar to COVID, the market bottom starts to move up. We're still in the middle of a shutdown. I kind of think that the China stock market is kind of telling us something about this, where we will see this China outperformance. But once again, like going back to Kevin's point, we just haven't seen it yet. But I think the price action is kind of telling us something. But I also like the idea of silver here. And so just to make it an easy level for everybody, Kevin, for me, my long-term models, I've been long for a while. Probably, I think it's been about a year now. We haven't been stopped out of the position. We haven't hit a sell signal yet. But if you're a tactical trader like you are, and we're looking for this breakout, what's the level that you would say, hey, everybody, when silver gets over this level, it might be a buy when it gets a nice close over this level?
Yeah, $36, and then also that volume candle that coincides with that breakout exceeds 30%, or basically 130% of volume that we've seen on average for the last 20 weeks. That's how I kind of look at those. And then until we get that, I once again, I think you kind of be a little bit more cautious with it. And then any type of breakdown, you get a breakdown below 30, I think that's where we actually go down and see around $25. $24 some change, $25, make it rounded even. So once again, higher highs, higher lows. The trend is still up, and maybe it's consolidating for that breakout. So we just have to kind of wait. A lot of the, the commentary you're going to hear from me today, Jason, a lot of this is kind of more wait and see. It doesn't mean I'm like really bearish on this stuff.
No, there's a lot bullish,
but it's just like
there's so much information right now. Yeah. Like almost like that's why we kind of do these weekly, which is sometimes, and I always say this on my channel all the time, which is like, I know sometimes trading and paying attention to what I'm doing gets boring, but I'm actually running an actual fund. I'm actually trading it, which it is really boring sometimes. There isn't trades to put on every day. There isn't something to do all the time. There's sometimes just a wait and see, as Kevin said. Like if you were starting with fresh money today, Kevin's level is a way for you to get into these trades. But would you just go and buy silver today? No, and I wouldn't, and I don't think Kevin wouldn't. Would I buy gold today? No, I wouldn't, and I don't think Kevin wouldn't. But me being in these trends already, it makes sense. But we're talking to you guys about if you have $0 or if you have cash on the sidelines in zero positions, you can jump into some of these by paying attention to some of the levels we're talking about.
Yeah, and also too, take advantage of the implied volatility that we are seeing in the market, right? The volatility itself is also providing some opportunities. So like, I'm not a fan of SLV too much, but that's kind of the best proxy that people actually have. So like, you can look at the SLV and it's going to have a little bit of a different price level. You're looking at, could it go down to 2280? It could, right? And so if you are a buyer at the 200-week moving average, can you sell premium at that level? Can you sell some premium a little bit higher, maybe at $25, right? And go out a little bit more, capture some, take in a credit and wait and see it. And you got to be willing to be able to buy it at that level. But that's where you can kind of also get exposure, in that wait and see type of environment. And I think that's kind of the route that I've been really kind of harping on lately. Sometimes you don't have to sit on your hands. You can still, collect some premium. You can still make some profits. But once again, I gotta see something that fundamentally, changes in the demand side of the equation, and it's not. And we're making lower lows on the RSI, MACD making lower highs, lower lows. So it is kind of signaling that there's some exhaustion, and until you have a narrative shift, once again, I'd say trade the range.
Yeah, it can consolidate, and inside of a long-term trend, consolidation is very healthy, and that's a lot of thing that people always get upset about consolidation, and it's like, no, man, this is if gold continued to just rally parabolically, and just looked like cocoa, let's say, I would be very bearish on it. I would say at some point this thing, yes, I'd hold a position if I continued to see the trend being up, but I would have a stop loss, a trailing stop, an exit ready to go, and I wouldn't be very bullish on it.
Yeah. Yeah. Let me go back to gold here because I forgot to mention this. And sometimes the best thing is just to ask yourself questions.
Mhm.
And I think the question that I've been asking myself for the last 6 months, and now it's starting to ring true a little bit more, is gold trading like a risk off asset or a risk on asset? On Monday, Tuesday, Wednesday, and Thursday of this week, was gold trading as risk on or risk off? And that's kind of where you get that flight to safety as the gold trade is usually more risk off when you have these parabolic moves to the upside, right? When you have a COVID-19, when you have a 2008 type of crisis, when you have a 2016, 2017, we may be going into a recession type of crisis, right? What happened with gold? But now it seems like there's such a strong correlation and has been with the gold moving up and the S&P 500 moving up. And that's not normal. And so that's where I'm like, Friday was actually kind of a telltale sign. Like, even though we had that nice little run towards the end of the session, you started seeing a little bit more of a fundamental breakdown, actually on Thursday and Friday, fundamental breakdown when it comes to gold. And when gold starts trading as risk on, that's when you kind of say, all right, well, like, that's just something to kind of keep on the radar. And that's
No,
how
for
I look at it
sure.
right now. And I think a pullback it would really reset that a little bit, get some of that froth out of there, reset it back to its core dynamic or the core value of the reason why we trade gold.
Absolutely. And we'll get to questions the moment I see your question, Wavy. One sec. So coming here, now we're looking at the Fed rate, the 2-year Treasury yield, and I use this chart all the time. And it's something that I always pay attention to because the 2-year yield seems to run what the Fed is going to do in the future, and that makes a lot of sense. Honestly, I'm not a person who just talks about the Fed, being good or bad all the time. But at the same time, it's like most of the time the Fed's just going to do what the 2-year yield says to do, and that makes sense. And not to mention, they also control the short end of the curve, so they have to also be in line with it. So looking at this chart, we're seeing that, back in, I think that was August or September, we saw basically the Fed started to lower rates. The 2-year yield just went the other direction the whole time. Huge bounce in that, just kind of signaling that maybe some inflation was coming back in. As it caught up to the Fed rate, now it's turning back over, which is signaling to me that we're going to see more rate cuts in the future going forward. So, Kevin, you haven't been on in a while. I wanted to ask, what's your opinion on the Fed right now? Any thoughts on where they're headed, what they're doing? Because Sam and I and Rick and I, we've been talking about it a ton, but I want to get your opinion on this.
Yeah. So if you guys hear a pigeon in the background, I'm sorry, but I got a pigeon on my solar panel. And that
Nice.
thing's going hard in the paint right now. And I'm like, and if you know like how a pigeon sounds and you don't know
Yeah,
it's a
I
pigeon,
heard
it
it.
might sound a little bit weird. And
Yeah,
so they like to party on my solar panel for whatever reason. So
like
if
it.
you hear that in the background, that's what that is. Look, I think the Fed's kind of in a rock and a hard place right now, and I don't think that they're going to get the data that they want to see until we get to April. And unfortunately, they're going to want to see 3 months of decelerating inflation. Did they get that on Friday when it comes to PCE? In a sense, but you still are seeing month-over-month prints coming in fairly hot, which will then have an impact when it comes to inflation and making it a little bit sticky. So if we do see PCE still sitting at around that 2.4, 2.5%. I think it kind of makes it a little bit difficult unless they actually do see a meaningful slowing when it comes to the consumer and the economy. The consumer side of the equation, retail sales came in light in January. If you look at the November numbers when it comes to consumer credit, we actually saw a contraction number in that particular print, which is actually very concerning. Usually we don't see contractions in consumer credit just in general, unless something's up. We've seen better prints since that one, but that's also something I've been kind of keeping my eye out on. And then the data set on Friday, personal spending contracting by 0.2%, personal income skyrocketing higher, and then savings rate moving higher as well. And savings rates, as they go up, usually consumer spending goes down, right? We save more, we spend less. It's a pretty easy equation. So I think they're going to be kind of in a rock and a hard place. Is the consumer cracking, or is a lot of this inflation, or is a lot of this data that we've seen over the last 3 weeks, 4 weeks, more related to weather events? And we don't know. That's what makes it very hard. And if the Fed is going to discount it because of weather, and it's not, then that's a problem. They might wait too late. If it's not weather related and just so happen to be the fact that the consumer is kind of slowing down, then we probably are behind the curve, and we'll most likely will be behind the curve, guys. I mean, that's going to happen. So do I see? I am still in the belief that we will have 2 maintenance cuts this year at a bare minimum, and I think you can kind of justify that for the Fed. 2 maintenance cuts of 25 basis points, 50 total for the year. And I think you get your first one in June, regardless of what actually happens with inflation, because they also have to be mindful of liquidity in the markets as well, right? And you do not want to see a meaningful slowing in housing, like a massive slowing in housing, because that's going to take a lot. And then we have the Doge cuts. What that going to really do when it comes to the unemployment rate? You'll first see it with contractors, private contractors that contract with the government. You probably are already seeing that in the initial claims data. So if you get some labor market weakness, maybe that's going to accelerate them. I also believe that if you're kind of looking at it from a technical standpoint, I think yields just across the curve, especially on the 2 years, just been built up because it has been risk off for those fixed income traders, right? And that kind of coincides with the pullback that we've seen in the S&P 500. And I think the 10-year or the 2-year actually still has more to go. If I look at the 10-year futures, I mean, I would not be surprised because MACD is actually crossing and had a bull cross this week. I would actually not be surprised if we actually see 104, us hitting the 104 spot 1 level, if you're looking at the 10-year futures. And then if you kind of go back and if you want to back that in to, well, what does that mean for actual rates? You could probably see rates going down to on the 2-year front, probably hitting about 3.5, maybe even lower than that. So that, I feel like it's a very hard thing to kind of time right now. There's so many things that are happening, but I think the Fed does too in the environment that it has right now. And if inflation does crack to the downside, I think they'll do a lot more. But it's going to be very hard for the Fed to cut rates aggressively, like some people want to see. And inflation staying where it's at right now. And then also the wild card too, like, do we actually get Doge payments? We laugh at stuff that's been mentioned like that, but like, we got to take everything that that the White House says very seriously. And so, do we see a $2,500 or $5,000 or $5,000 check that gets sent out, which would be immediately inflationary, right? And the Fed would be very hard pressed to be able to cut in that type of environment. On the other hand, though, a lot of these government agencies that are being, these contracts are being canceled. Some of this is kind of like a headline mover. Some of these contracts that they're canceling, we already spent the money. So it's kind of like, okay, you canceled it in a symbolic manner, but the money already has been spent. I'm not sure how you're going to be able to repatriate that back. But over time, government spending will go lower, it sounds like. And if that's going to be the case, that will have a meaningful impact when it comes to the economy. Because if you're looking at GDP just as a whole, very high level, right? You have basically import exports that's going to impact GDP. You have government spending, and then you have private capital. So the thought process is, we're going to see probably a little bit more of a ramp up in private capital, but is that going to be able to offset the slowing of government spend? And people, you can say whatever you want about government spending, has a meaningful impact when it comes to GDP. And if that's going to be the case, we kind of have this little bit of an offset. You're kind of looking at the horizon of having very minimal growth, if not contractionary GDP prints that could be on the horizon this year. The Atlanta Fed did update their GDP Now forecast, and I think they're forecasting a contraction of 1.6% for Q1. Do not freak out about that, because that updates as data comes through, right? So if you believe that maybe it was a blip on the radar that consumer spending contracted by 0.2% for the month of February, if you are concerned about that, or for the month of January, right? If you are concerned about that, then the month-over-month print probably should see a meaningful rebound for the next print, which would then kind of offset that. So That's where I know I talked a lot there, but that's where, the dynamics are. Do we have a meaningful slowdown when it comes to growth where the Fed may have to cut? But is that meaningful slowdown in growth and the Fed having to cut still rely on inflation staying at 2.5% and uncertainty about monetary or fiscal policy? That's where it makes it a little bit difficult. And then do we start talking about QE at the end of the year? I don't think we get into the QE conversation, but that could happen. Right? When we do have these contractions and we do have massive pullbacks, things change on a dime. So
Yeah.
I think the trend here, when you're looking at the 2-year, 10-year, I think it's in the right direction. Technically, I think there's still a little bit more room to run to the upside there when it comes to bond prices on the Treasury front and yields kind of moving lower. It might be a little bit bumpy after we've had such an aggressive move to the downside. It might be a little bit bumpy, but I think that's the signal. I think the fixed income market is saying that the Fed's going to have to take some action, and they're concerned more about growth than inflation right now.
Okay, let's end on oil. So, Kevin mentioned, we had a conversation. I was looking at the band squeeze breakout. It was a good trade, made a couple bucks. But Kevin mentioned, the big thing with this trade is 80 would be his top target. Hits 80 perfectly, comes back. Now we're back at the low end of the range. So, Kevin, what are you looking here on oil? Do you have any ideas where you think this thing ends up fundamentally and technically? Because it's an interesting one this year.
It definitely is. So from the oil standpoint, the candle that we saw last week is actually very interesting. We have a doji candle. We did fail the 20-period moving average, and this is on the weekly chart. We did not see actually some significant buyers kind of stepping in once we tested it, so that kind of is a little bit concerning. Does that actually turn into an area of resistance, and do we have a fundamental breakdown of this wedge between that moving average and this trend line to the upside here? What I would suspect that we probably on early this week, probably tonight, and tomorrow, I would suspect that we actually see a little bit of a bounce in crude just because of some of the geopolitics that's actually taking place between Israel and Hamas. It seems like their ceasefire is fundamentally breaking down right now. So there might be a little bit of a geopolitical risk premium that gets built into crude oil for now, but nothing on the horizon for me really says that crude is going to have a meaningful breakout to the upside. I would still look at around that 77.5 level as your area of resistance. Seasonally, you will see exports starting to ramp up a little bit, so that'll be decent. Utilization rates now should actually start seeing a little bit of a pickup. Product supplied should also be a little bit of a pickup, so that'll actually kind of inputs to refiners should actually see a pickup. Product supplied will also do that. So we just have to see, are we going to be able to match demand for that? And if not, I do actually kind of believe, Jason, that we actually do break $65 over the next month or so to the downside. And that's been a key area for me. I might be wrong there, and we might continue to rise higher. Maybe we go back and retest that 200-week moving average. I wouldn't put it out of the realm of possibility here that we do have another weather event, because we're at the shoulder season right now when it comes to natural gas. And so usually when it's hey, we're getting close to spring, and then we have an Arctic blast, right? That's going to push prices higher. So I want people to kind of also understand too. I don't think it's going to be a straight move to the downside to $65 and potential breakthrough. I think we probably will see another bounce here, and I think that's going to be weather related, logistics related, especially when you're looking at the Bakken region. But I do believe that we see a fundamental breakdown. I do have the crack spread up there though, and that crack spread continues to move higher. So prices for crude oil continue to move lower compared to some of the byproducts like gasoline and heating oil. Now, gasoline should seasonally see a bid, and that's actually what you are seeing. Last week, this week, you're seeing summer blend prices being priced in, so that's going to be another 15-20 cents to the upside there. That's normal, but the reason why I bring that crack spread up, refiners are actually looking decent if you can pick the right ones to be able to capitalize on it, and that's kind of where I see that. I do want to make mention before we leave here. We have a pullback in the S&P 500, right? But be mindful that seasonally, this is normal. So on a longer term time frame, you can make the case that yes, a pullback is happening. This is a monthly chart. This is my doom chart. I'm calling it the doom chart too. because the doom chart here is the RSI breaking below that key overbought level to the downside, and we have a bearish divergence. And every single time over the last 20 years, and you can actually go farther, but there's a little bit of a distortion when it comes to prices. But every single time we kind of see that, that does kind of coincide with actually a meaningful pullback in the market. And we're only down from the highs. We're down, right? But when you kind of look at this technical setup when it comes to the S&P 500 and that MACD is hinging, like everybody, it's plain as day that MACD is hinging, meaning that we're stalling out. If you're a bull, what do you want to see? Consolidation here, consolidation in time, and then for us to be kind of pull higher. I think we will see a meaningful pullback this year. Doesn't mean it has to happen today or tomorrow. I wouldn't freak out about it. I continue to go back and say, hey, play the rotation. High dividend yield stocks have been doing a phenomenal job in this environment. Staples, there's certain staple value plays that are still doing a good job. You talked about financials. Financials usually don't show that type of strength like we saw, especially the regionals last week. If there was a major growth concern yet, but the technicals kind of signify like, hey, we have a little bit more of a pullback here on the horizon this year, but this is a monthly chart. You can't trade tomorrow on the monthly. Right. Yes. All you can do is just keep it on the horizon and say, hey, like we see some weakness. This is where we're at. But the volatility that we saw in February and what we will see in the first 2 weeks of March is something that is completely normal right now. And actually for this week, outside of Monday, we're going to get some ISM manufacturing data. We'll get ISM services as well, I believe, on Tuesday. But we get hard data this week, and hard data has actually been a little bit more favorable for this market rather than sentiment, which is what those PMI numbers are showing. Those are purchasing manager sentiment, and they're not feeling that great right now. But once we start getting the actual hard numbers itself, it might show a little bit of a different picture. It might give us a little bit of a boost, back higher. In any type of fundamental breakdown here, and once again, I kind of go back to these monthly charts and say, hey, are we due? Have we hinged like this before? And we have, right? Unfortunately. And so this is kind of my, keep it on the horizon. It doesn't mean that those pullbacks have to last too long either. Our pullbacks have been very swift and quick. And so if we're going to keep up with that, yeah, does it get a little bit violent? Yep. But you got to have capital on the sidelines and be able to deploy as soon as that environment really does show up.
No, I like that because it's just something that you have to keep in mind. I think too many people, when they provide analysis, people are like, hey, the market goes up and it always goes up. And it's like, no, there's plenty of times where the market goes down. And either way, however you're trading, you have to have that risk on your horizon. So we got a question here. What's the most undervalued commodity right now? I got like a minute. So if you want to add to that one, Kevin, and I can't say undervalued for commodities, and just in my language, I don't really have a word for that. I think commodities are things, for me at the very least, where you buy them in uptrends, they make very big moves, and you sell them in downtrends because they're not like equities where they just always go up. But I do like the idea of like some of the things we've talked about today, which is silver, the gold mining space being up, 15 to 20% just to start the year. That's really, really significant to me. So I still like the silver and the gold miners play. But if you're looking for, things that you could buy cheaply that could move a lot, I think palladium might be one of those. So Kevin, do you have a commodity pick? Not financial advice pick?
No, yeah, not financial advice, but if you're looking at it over the next couple of weeks, wheat. Wheat is probably and red winter wheat. So it has some headwinds, but that's the biggest one right now in the complex, in my opinion, that is the most at risk for weather premium. And when you're looking at March and April, it's very important that we get the right weather conditions. We don't have droughts, which we have actually. Drought conditions are creeping up here. If we don't get the weather, if we don't get the rain events or the precipitation events, that could actually impact the growth of red winter wheat, and that's where you could have a little bit of an an issue. So doesn't mean it can continue to go lower, but if you're looking at risk reward, I would say wheat right now is probably the one that the market's been shorting a lot. Weather premium's not really built in. you probably see it come down a little bit more. I'm not saying like right now, but like you probably see it come down to about 5.25, so $5.25 or so, 5.22, and then that probably would be your value zone.
Nice. So, all right, guys, thanks for joining us on Sunday. We'll be with you actually tomorrow at 11 a.m. Eastern time, and then Friday at 11 a.m. Eastern time for the Holy Macro Show. So we'll see you guys then. Kevin, thanks for joining us. We'll be doing these a little bit more soon, probably after market hours. So we'll see you guys soon.